Good afternoon and welcome to this ACT webinar on supply chain finance. I'm Martin O'Donovan, Deputy Policy and Technical Director here at the ACT. Before we get going, a few technical points about our webinar setup. There's a menu bar across the bottom that allows you to open various windows, and you can move these around and resize them or minimize them. There's a green button down there with a question mark on it, and that's for help if you've got any technical difficulties. And there's another button there which opens a Q&A window, and that's for sending in questions for us to take at the end. I should explain this webinar will run for 45 minutes and we'll have two presentations. So can I welcome our two speakers? First off, we'll have John Bugeja, Head of Trade Sales within the Transaction Banking at Lloyds Banking Group. Lloyds are sponsoring this webinar and indeed several other ACT events over the rest of the year. So thank you very much for that. Today, John will be setting the scene and explaining about what constitutes supply chain finance and how it will fit within your organization. We then have a presentation from Daniel Jefferies, who is responsible for debt and capital markets at EE, the mobile network provider. EE is a user of SCF, supply chain finance, with a program from Lloyds. So Daniel can tell us about their practical experiences. We'll then finish with discussion and questions. You can send in your questions through that Q&A window I just mentioned. There's no need to wait until the end to send them in. Just send them as they occur to you. If we do manage to take your question at the end, we'll not be broadcasting your name or company details. Then finally, can I just add that a recording of this webinar will be available on the ACT website in a couple of days' time, along with a copy of the slides. So, moving on. Supply chain finance is one of those financing ideas that really does seem to work some magic, in that all the participants seem to be able to get a benefit. It's a real win-win situation. However, it does suffer a little from confusion over terminology. So to explain all, can I hand over to John from Lloyds?
Good afternoon, John Bugeja here from Lloyds. What I would like to do initially is just give you a quick run through of what I'm going to cover, and then we'll move on to the details. So key starting point really for me is, what do we mean by supply chain finance, and is it actually new, or have we been doing this for 100 years? I think the answer is we've been financing supply chains for an awfully long time. Historically, we will have financed these supply chains using traditional documentary trade products. What we now do increasingly is operate in the open account space using digital data instead of documentary trade products. But the fundamentals are the same. The characteristics are still largely the same. So supply chain finance is event-driven. In this case, the events are in the physical supply chain. We are providing finance, as the name suggests. There's often a degree of risk mitigation involved in the solutions we provide, and then at the end there's a settlement. Additional factors in the digital space include visibility, control, efficiency gains, and also the important subject of balance sheet or accounting treatment. As we move on to, in a second, onto the next slide, one of the things I will mention is the difference between credit risk and performance risk, which makes a material impact on the way supply chain finance works. We'll look at the benefits to the supplier and benefits to the buyer, and we'll look at a real-life typical trade cycle. It's actually quite a complex trade cycle, but I've done that deliberately in order to illustrate that a client typically sits in the middle of a supply chain, and therefore has two trade cycles going on at once. They have a sourcing cycle and they have a selling cycle, and the two things typically overlap. So what I'm showing you there on the screen now is a typical trade cycle and the traditional trade finance solutions that will be applied to deal with the various stages in the cycle. So what you can see there is actually what some people refer to as a closed loop model, or a self-liquidating model. And in this case, the client is tendering for the business on the selling side first. In other words, they're securing orders for their goods. When the sale is agreed, they've got a purchase order, they're then ordering the raw materials or the components or whatever it is they have to source on the sourcing side in order to make those goods. And as you can see, as the line progresses, the goods are shipped and invoiced, goods arrive, payable is then approved, and on the selling side, as the goods leave the factory as completed end products, the end buyer is invoiced, a receivable is created, and eventually they get paid. So I don't want to dwell on that slide because that's dealing with the old world of documentary trade, but that's just to illustrate the point. That's how we would have financed the supply chain in the past. Turning to the new world, we have a slightly simpler picture, but it's exactly the same trade cycle. When working there from left to right, the various types of supply chain finance are illustrated. The one we're going to focus on is the supplier finance, which is the most popular and the typical solution that we tend to see today. But there are other types of supply chain finance which is worth a quick mention of. So purchase order finance is really about financing the pre-shipment period. So if you're sourcing and you need to be incurring engineering costs or pre-shipment costs, presenting the purchase order and getting finance against that would be regarded as a supply chain finance solution, which is in the purchase order space. Inventory finance, again, is when the goods are physically in your warehouse or going through your production cycle. And then receivables finance is where, as a seller, you have raised an invoice, shipped the goods, and you're accelerating the payment. So that's the story of the different types of supply chain finance, leaving us with the one that's the real focus today, which is supplier finance. And the characteristics of supplier finance are that the lead party in the supplier finance relationship is actually the buyer. So the buyer is initiating the program, and it's typically a relationship of one buyer to many suppliers. We do have situations where it's one-to-one or one-to-two, but more typically it's one-to-many. And the defining characteristic which makes supplier finance different from the other forms of finance is that it is triggered by the approval of the payable rather than by the shipment of the goods or the raising of the invoice. And that's a very significant difference because once the payable is approved, we have eliminated performance risk. So if you recall what I said earlier, there's a difference between credit risk and performance risk. At the stages prior to the approval of the payable, there is a performance risk. That payable may not be approved because the goods may not be correct, they may not be shipped on time, they may not even exist in some cases. Once the payable is approved, we've eliminated the performance risk. The mechanism for actually raising the finance is to purchase the receivable from the suppliers. So in that sense, it is a receivables finance program, but it's against the background of an approved payable. And the supplier, and indeed the buyer, accesses all this information through a platform. So it's all electronic, it's all digital, very much a straight-through process, and therefore pretty cost-efficient. So that's what we mean by supplier finance. Some people refer to this as approved payables finance. It is exactly the same thing. There are various names. It's all the same stuff. So that's what we mean. So what are the benefits of supplier finance? The benefits for the buyer, and we need to be careful how we position this actually. When we say increased days payable outstanding, it doesn't necessarily mean extending days payable outstanding to something which is no longer commercial. It means taking the days payable outstanding out to the industry standard and trying to standardize them as far as you can. Not always possible to standardize them across all suppliers, but by and large, if you can manage your payables on a standardized industry standard basis, then it is more efficient for you as a buyer. Reduced cost of goods sold, reduced cost of goods sourced, I should say. The key point there is the benefits to the supplier actually end up being benefits to the buyer. If the supplier can raise finance more cost effectively, or raise additional finance so that their production cycle is more efficient, then that means the cost of the goods that they're selling to you as the buyer will be reduced, and that can be reflected in the price that you pay. Stabilizing the supply chain and the suppliers within the supply chain. I think many years ago it would have been the practice to source from the cheapest supplier and switch suppliers at very short notice in order to get the best deal. These days, in the last 10, 15 years, that's become really not the acceptable way of behaving. And typically, most big buyers will actually try and ensure that the suppliers are able to operate consistently and supply them consistently. And we're not going to have a situation where they have empty shelves if they're a retailer, or their production line stops because one single component has not been supplied because the suppliers run out of money. So supporting the supply chain is a key buyer benefit. The social responsibility thing is basically treating your suppliers fairly, and this is a good way of ensuring you treat your suppliers fairly. And finally, on the buyer side, balance sheet neutral. Again, sensitive subject this, because you need to be careful not to overstate the reality. The way the programs are designed, they should result in no balance sheet impact to the buyer. In other words, the trade creditor treatment remains unchanged. But each buyer has to validate that with their own auditor, and that's a process that is really case by case. On the supplier side, the benefits are actually reduced days sales outstanding. So ironically, both parties achieve the objective there, which is one of the reasons it's a win-win. The receivable on the supplier side actually is turned into cash. So it does reduce the days sales outstanding. Reduced finance cost. By and large, the buyer will be a stronger credit rating than the seller. Not always, but by and large. And in most cases, the buyer will be an investment grade client as well. Therefore, the benefit, the reduced funding costs associated with that credit grade will be reflected in the price that is paid by the supplier for the receivable. So there's a cost reduction there. Access to finance, which is decoupled from balance sheet strength. What that means is the supplier, who may be an SME or a mid-market company, typically the amount they can borrow is largely dependent on the size of their balance sheet and the level of security that they can pledge. The supplier finance solution is completely decoupled from that. It's based purely on the level of approved payables that they can present for us to purchase. I think the other efficiency gain, I think, for the suppliers is that they get visibility into what's been approved, and they've got absolutely 100% certainty about the amount they're going to get paid and the timing of the payment. So it's an efficiency gain there in terms of credit control. And finally, because this is based on approved payables with no performance risk at all, these are non-recourse financings, which means that the risk has been eliminated, such as it is, given the investment grade nature of the buyers, the risk has been eliminated. And I think those are the main benefits for both parties. And just to wrap up before I hand over to Daniel, the success criteria, what are the drivers behind a successful supplier finance program? I think two stages there, program initiation and then program optimization. On the initiation side, collaboration within the company, within the buyer company is key. It's between treasury, finance, procurement, all of the stakeholders that are involved in the procurement process and the payment processes and the finance processes. Absolutely key. Everyone has to be on the same wavelength. A dedicated supplier onboarding site is also important. Supplier onboarding is one of the more difficult aspects of the supplier finance program. So having a dedicated focus and an onboarding site to make it as easy as possible is key. Consistent messaging is also key. If the buyer, the client, has determined that this is a good solution for them and a good solution for their suppliers, they need to tell the suppliers pretty consistently at supplier conferences, in their general communications, that this is how the program works and we really would like you to use it. Prioritization of key clients, very important. If you have 2,000 clients, it's going to be a slow process onboarding them. If you prioritize the top 100 or the top 200 that make up the bulk of the sourcing, and these are the suppliers that you have long-term, long-standing good relationships with, they're likely to come on board very quickly, and it will be a successful program. You have to bear in mind that once you've approved a payable, you're on the hook. So dealing with suppliers that you've never dealt with before on this basis is not necessarily a good idea. And finally, on the initiation side, project managing it from end to end, ensuring that you treat this as a project, I think works. And this goes for the bank as well. All of these requirements apply equally to the financier as well as to the buyer. Once the program is running, a good idea to monitor the benefits to make sure you're actually realizing the benefit that you expected to get in terms of working capital benefits, and also any cost savings that you expect to get through improved pricing. Efficiency gains through standardized payment terms. Again, let's make sure we leverage those and take advantage of those opportunities. The supplier finance program should then be embedded as part of the BAU procurement process. So any new suppliers coming on board, if they are a sufficiently large supplier, a material supplier, then they should be adopted onto the program almost automatically as part of the BAU process, so that you continue to leverage the benefits. And finally, where you are looking to extend the credit period to an industry standard, you need to make sure you actually do that with all the new suppliers coming on board as well as the existing suppliers. So I think those are the success criteria that I would focus on in order to make the best, derive the best benefits from the program. And I think on that note, I shall hand over.
Okay, Daniel, do you want to take us through your experiences at EE?
Yes, thank you, John. Thank you, Martin. So my name is Daniel Jefferies. I look after the areas of debt and capital markets at EE, and I'd just like to take you through our experience of implementing supply chain finance within EE. So to start with, what I just like to outline is how the initiative started and who was involved. So from initiation, the supply chain finance program was driven by both the Treasury and the procurement teams. This was in recognition of the fact that both bank relationships and supplier relationships were central to making this initiative actually work. We worked together in broader teams to make sure that the wider stakeholder interests were actually represented, and actually their objectives were actually met as well. As we went through the process, it's important to note that this would not have been possible and would not have been achievable to put something on the table for suppliers without the help of the accounts payable and systems team, who actually came into it later down the project once it had started and actually got up and running. To basically understand the offering, to basically understand how it worked, so we could actually market the initiative internally, we went through and analysed and studied quite carefully the relationship banks' presentations, and we also did a bit of wider reading around the subject as well to understand exactly what it is we were looking at and what exactly we could and wanted to achieve out of this whole initiative. So when we set about doing this, our key benefit was to actually support supply chain in standardising the payment terms to our suppliers, which was an ongoing process within EE. One of the other key initiatives was to ensure that there was going to be no disruption to existing EE practices. Obviously, we need to make sure that the cash changes hands and to ensure that systems aren't disrupted and interrupted by implementing a new scheme. And obviously, one of the other benefits and objectives was to try and garner a working capital improvement. So, choosing a partner bank, having established that we want to go down a supply chain finance offering, we applied our standard internal process of selecting potential providers. We adopt a policy of discussing and approaching our existing relationship banks first, and giving them an opportunity to present their offerings to this business. How did we do it? Well, we actually went through a formal RFP process, and in that RFP process, which was quite comprehensive, we actually applied scoring criteria along a number of different areas. So, for example, on implementation, it was important for us to establish what the teams were from the various banks, what their experience was, what their scale was, their geographic scale was. Management information, it was important for us to understand what could be delivered to us in terms of understanding how the implementation was going, what the take-up rate was going to be, which suppliers were in discussion with banks. And also, one of the areas we wanted to understand was business continuity. That is just in recognition of not only what would happen if the bank's platforms failed, but also understand what if Armageddon scenario happened and one of the banks failed as well. Would this have a material impact on our suppliers? And also, we wanted to understand what the financing and capital constraints, requirements, and issues could be. At the outset of the scheme, you never can tell how successful or not a scheme can be, but we needed to understand is, if it was very successful, what were the bank's abilities to service our suppliers and provide the offering that we needed. Once we've gone through the formal RFP process, the three banks, the top three banks, were analysed, their scores were compared, and we actually were faced with a very interesting proposal, which was one that was offered by a joint submission from Lloyds and JP Morgan, which truly gave us a very, very attractive proposition. So, features of the proposal itself and how we actually implemented that. Well, one of the key attractions was that we were offered one set of documents to sign. This was important for EE to understand that we were only going through one set of negotiations, not two sets of negotiations, not two sets of execution documents, and so forth. The other attraction was that we needed to structure this program so that both banks could participate in the funding program, and obviously it would give us the capacity and the scope for growth, annual coverage as well. One of the other features is that the offering utilises a single access point, which is common to both banks. We weren't using two sets of software. Suppliers weren't going to be confused with two access points to understand discount invoices that were presented. And in summary, the benefits were that we had two banks' balance sheets to utilise. We had Lloyds with a very strong brand within the UK, and JP Morgan with a very strong brand that could cover global suppliers also. And obviously, we have one system platform that is available for both us and also suppliers as well. So if you're an international supplier, you were not being differentiated in terms of a UK domestic supply. So where are we now and what have we achieved? So we initiated our program in September 2013, and we are to date very pleased with the progress we've made and the experience that we've had. Procurement have worked closely with our banks in our respective jurisdictions, and we have been able to maximise the strength and the competencies of both banks in onboarding our suppliers. Actually achieving this, we've actually achieved this through weekly steering groups, weekly project management calls, all very important, may feel a little bit tedious on implementation, but very, very important to actually hit the deadlines, actually meet the objectives, and actually get a product that actually works for both EE and the suppliers as well. Another area that was very helpful was a series of internal workshops between EE and the banks. This was very important because it actually helped EE, stakeholders within EE, to actually understand what it is that we were making available to our suppliers and how it could be utilised within the group itself. And I believe it's fair to say that our working capital objectives have generally been met.
Great. Thank you, Daniel. It really sounds as if your system is up and running and delivering what you wanted it to do. Before we move on to the general questions and discussion, I wonder if I could take the opportunity to do a poll of people attending the webinar. Just to give us a flavour of how far down the road you all are on considering supply chain finance, I wonder if you could respond to this question by simply ticking the appropriate box. So the question is, how far has your company come on the SCF journey? 1, we've not considered it. 2, we've considered it but decided against it. 3, we continue to assess supply chain finance but are not yet convinced. 4, we're currently implementing a program. Or 5, we actually have a program up and running. So if you can tick the appropriate box, basically they're in a sort of order of progress through the process. Just wait for the responses to come in, and then we can have a quick look at how things stand. Great. So there we have the responses. So there's 28% have not yet considered it, so there's a chance to do that after this session. But 20 plus 30, just over half of you are actually embarking or have embarked on a supply chain finance program. I suppose this audience is somewhat self-selecting, but that's actually quite encouraging. Shall we move on to the next question? What would you see as the key drivers of setting up a supply chain finance program for your suppliers? Based on your understanding, and it looks as if a fair number of you have been looking at it, could you just mark the top two attributes that you think would be key benefits? So we've got extending payment terms, standardization of payment terms, added security of supply through supporting the financial viability of your supply chain. 4, just general efficient procurement and working capital practices. 5, enhancing supplier relationships. 6, good corporate social responsibility practice, or some other attribute. Some of those are a little bit overlapping, but if you can just choose which one sort of chimes best with what you think are the key benefits. So a little bit spread throughout the different attributes. Top there is just the general efficient procurement and working capital. Extending payment terms comes in at second place. And obviously here the percentages add up to more than 100%. That's what it's bound to do. Any comments from my colleagues around the table here, or is that broadly in line with what you might expect?
It's probably what I would expect. I think maybe the benefit of supporting the financial viability of the supply chain may be a little understated by those sort of respondents who haven't yet implemented it. I think maybe in real life that's actually a bigger.
And that's interesting you say that, because certainly my experience from talking to people about this subject is that ends up being the absolute crucial thing.
Yeah,
because if your suppliers are struggling, and this was particularly true as we went through the sort of financial crisis, that became the real driver.
Yeah. Empty shelves or a stopped production line tends to be pretty serious.
Yes.
And that's really what that's all about.
I think we've just got time. We have one further poll question which we'll go through now, and then we'll get on to the general discussion. So setting up the program certainly has some benefits, but what issues do you see might need to be overcome or might hold you back? And here, if you just mark any that you think are relevant, so as many or as few boxes as you feel appropriate. So, what could hold you back? It's too complicated, or our suppliers wouldn't really want it. 3, it's insufficient benefit for us. 4, lack of clarity as to who internally should take responsibility. 5, unfavourable accounting, or some other negative attribute. So now we have the answers there. Fairly even, really. I suppose the truth is all those particular attributes could be discouraging or hold you back. Some of them, though, if you think about it, shouldn't really be problems, as in lack of clarity as to who internally should take responsibility. That should be capable of overcoming that one.
Yeah, I think in my experience, I think, and that was the first point I made, which was that in implementing this solution, the two key parties that need to be engaged are Treasury and procurement, because you're dealing with banks and you're dealing with suppliers. So I think it has to come from there. And
both.
It's for those guys to corral the troops to support the initiative.
Yeah, but the response that surprises me a bit is our suppliers would not really want it. I think the opportunity to finance a receivable on a non-recourse off-balance sheet way without tying up your credit facilities is generally quite a popular thing with suppliers. And in our programs, the feedback we do get feedback from the suppliers. 90% of them love the program, find it very easy to use, and they really do see that benefit.
I suppose to some extent that might depend on what sort of suppliers you have, because that leads into one of the questions that we've had, which is really talking about the occasion. Let's move on to questions generally now. Is it essential that the buyer has a better credit standing than the supplier? And what happens if your supplier is very much at the same credit standing?
Well, I'll pick that up first. I think it's not essential, but it's typical. By and large, the buyer is the dominant party in this program, and it's the buyer's better credit rating that drives the benefits back down through the supply chain to the suppliers. It is conceivable, and it will happen from time to time, that the reason the program is being put in place is not specifically to leverage the credit strength of the buyer, but it may be something else. And it may be that we would operate particularly on a one-on-one basis where you have one buyer, one supplier. It is quite possible that the roles are sort of reversed, and the supplier wants to be part of this program for a different reason, and maybe the emphasis is more on risk mitigation and balance sheet treatment rather than access to cheaper finance. But most of the time, I would say the buyer will be the stronger credit party in the relationship.
Yeah, that's an interesting point, John. I think that one of the things to also consider here is that when a supplier goes into supply chain finance, it gives them the option to draw that cash early if they so choose. That option is based on the buyer's credit, so it doesn't impact their own credit, and it does allow them the opportunity to manage their cash in however they wish. They can draw on it early, or they don't have to draw early. It's a binary decision, so it does offer that working capital management aspect, cash management aspect, which I think is quite important.
I think the other, as I said, there are various drivers which might persuade a supplier to enter into this sort of program. One of the main ones for a larger supplier with a less strong buyer might actually be the balance sheet treatment, pure and simple, to take the receivable off balance sheet.
Okay, thank you for that one. There are actually several questions which I'm going to merge together around the sort of onboarding process. A very straightforward one for John, which is what is an onboarding site that you mentioned during your presentation. But in addition, just in general, how does that onboarding work? Is it the buyer who does that, or does the lending institution help in that process?
It's a combination of the two. I mean, the onboarding site is a site where the suppliers can be registered and the arrangements established whereby they can express their desire to sell their receivable to us under the programs, and then we can go ahead and do that. So there's a certain amount of documentation that's required, or legal agreements that are required with the supplier, and we try and make that as easy as possible. I think in terms of who drives that, it is the bank's sort of process that does that, but actually it wouldn't work unless the buyer were very, very much promoting the onboarding of suppliers. If we were the only party trying to get the suppliers on board, we'd never get any suppliers. The buyer is absolutely pivotal to getting the suppliers to come on board.
Sorry to cut across you, Martin. I mean, in my experience, I personally was involved in discussions with some suppliers around educating them in terms of what supply chain finance is, what the features are, what would the onboarding process look like from their perspective, and generally how it would work. I echo John's comments that we were involved in that from my perspective in Treasury, and also obviously the supply chain guys were involved in that process as well.
Now, clearly, there is some explaining and presentation to your suppliers on what it's all about. But I've got a specific question here: were any of your suppliers resistant to joining the program? And did you then try to overcome it, or, as you said, in a way, it's for them to decide anyhow?
Yeah, absolutely, Martin. It's an option that is available. It's not something we would force people to take, and I'm sure nor would Lloyds. So no, it's not something I think we would force on people at all.
Okay. Again, talking about credit and the actual provision of the finance, does the finance provided count against the lender's limits for the buyer? Is it using up the buyer's debt capacity? I think that's asking.
Yeah, I think the short answer is yes, it does, because that is the source of repayment. Having said that, we're dealing predominantly here with investment-grade buyers, and the nature of the program actually makes it very, very easy to share that with another bank, as indeed we do with JP Morgan in this case. So if a program is getting pretty big and that would start impacting the debt capacity, then before it becomes a problem, we'd start talking to the buyer about which other bank would they like us to bring on board in the same program, and it would be a collaborative process. It'd be fully disclosed. But it means we can ratchet up the appetite by simply bringing on partners.
Absolutely, and in the selection process, that was one of our key criteria that I discussed earlier, that we wanted to understand what banks' capacity was, whether it be for temporary movements or wholesale movements if the program became much bigger than we first anticipated, moved into territory that we had anticipated. So yes, absolutely.
Okay. On sort of vaguely accounting, so I think this is accounting, please explain how SCF is balance sheet neutral. I assume that's sort of asking about what is the accounting treatment.
I'll take the first part of this, and then Daniel will give a practical example.
I'm not quite sure what the term balance sheet neutral is.
I think what I meant by balance sheet neutral is it doesn't change the accounting treatment of the payables. So the payables remain trade creditors on the buyer's balance sheet. And the programs are designed with that in mind and have been designed in consultation with the accounting profession, with the auditors, so that in principle that should be the answer. However, the answer is then determined by the auditor of the buyer as to whether that is actually the case or not.
Right. No, that's familiar to us. At the ACC, we did a report on supply chain finance some years ago, and there were worries around the accounting and whether in some circumstances that trade payable could somehow be recategorized as debt.
As bank debt. And that's what the structure of the program avoids that, but it is down to the individual auditor to sort of opine on that. And one of the main issues there is that we are purchasing a receivable from a supplier. Yeah, that is the transaction.
Well, clearly, these programs are in existence and up and running and working, so that's not an insuperable problem. Just another very quick one is, where does this stand in terms of impact on the credit rating of the buyer company? So we're using up some sort of debt capacity, but in terms of the credit rating of the buyer company,
I don't believe it should have any impact, because these are obligations the buyer has anyway. Yes. So nothing has really changed. Yeah. So I would not expect to see any impact.
Absolutely. These are, and they remain, trade payables. Right. From our perspective. So they don't change. They were trade payables before the program, they're trade payables now.
In a similar sort of vein, looking at that same question from the other end, from the seller, supplier's end, they've now used their receivables to finance themselves. How does that impact on their credit standing and access to other credit lines or whatever?
I think it's a positive impact on the supplier. the challenge to avoid, really, the obstacle to avoid, is if a lender to the supplier is relying on those receivables as part of a security package to support, let's say, an overdraft, then those receivables will no longer be available. Having said that, the cash will be available instead, so their need for an overdraft will go down. Their day sales outstanding reduces, so their need for funding does go down. So from a lender to a supplier's perspective, just need to avoid double financing. That's the issue there, but actually it's beneficial to the supplier.
Thank you. There's another question here. What level of KYC, know your customer, or anti-money laundering requirement is there on the suppliers?
There is a level of KYC on the suppliers.
And that's undertaken by the finance provider, the bank.
That's right. Yeah. We're receiving instructions from the supplier. They request that we purchase the receivable. Therefore, they are the instructing party in that relationship. Therefore, we have certain obligations, right. And that's one of the reasons why we work with the likes of JP Morgan, because they need to be involved in the onboarding of suppliers that we can't easily assess.
Great. And there's just a... Oh, did you want to make a comment, Daniel?
No.
Well, I've actually got just a quickie for you there. How long did the whole process from sort of inception to implementation take? And I'm not quite sure when inception is, when you first started thinking about it or got approval internally, or...
Okay, so
give us an idea of the timeline.
Yeah, well, how long's a piece of string, really? From actually deciding we're going to do it to actually implementing it was quite short, I think, in our perspective. It was around about 8 weeks.
Oh, right. That is quite...
So
any agreement, that's pretty good going.
Which is why, the operational guys that put this in, they did a tremendous job of actually putting it in within that tight time scale, and they did a great job of getting it up and running. Obviously, the timeline from when we actually started talking to banks to get it implemented was a fair bit longer, to be frank, because we're going through the review process, the research process. Was it right for us? Was it something that would fit? How would it fit? What would the objectives be? All those types of questions. It did take longer, but from deciding we're going to go for it to actually getting it up and running was actually a quick turnaround. I mean, I don't know, John, what standard is or what normal practice is.
It's a little bit longer than that. I think that was a pretty quick turnaround. I mean, the process from initial discussion with a buyer through to onboarding suppliers can be several months, quite easily.
And actually, can I just come back with a personal question for Daniel? In that process of getting approval, obviously there's a lot of assessment and analysis to be done. And was any of it particularly contentious, or I mean, you mentioned working with your colleagues on procurement. Did that throw up any frictions, should we say?
No, I don't think it was a case of throwing up friction between different areas within the organisation. I think that one of the challenges is getting everybody on board to understand how things work, and it takes time to get momentum behind an initiative. That was probably the time, and that was probably reflected in the time between actually having first discussions through to deciding to go live with it. But
I guess, that's just normal in implementing anything, any new, any change. There is that process.
Yes, I think.
Of gaining familiarity. Good. We've heard a lot in a short space of time about how these programs work, and thanks very much for everyone who's provided us with questions. We haven't managed to get through quite all of them. What we'll try and do is give a sort of personal response to the people we haven't managed to cover. So, thank you very much to our presenters, and thank you to Lloyds for sponsoring this, and indeed to everyone who sent in a question. Going forward for the rest of the year, the ACT has some further events, notably our annual conference, which is coming up very soon now. I know Lloyds will have a presence there, so we can meet again there. There are workshops on supply chain finance during the course of that 2-day conference. And then we have another breakfast briefing on the same subject, which will be looking at further aspects of it. You can see there we also have various international events, and of course there will be a series of further webinars, so look out for those, which we will publicise as and when they materialise. Well, thank you very much, all of you, for listening and participating. If you can spare a moment to provide some feedback on the webinar, we'd be very grateful. If you could just select the red feedback widget down in the bottom bar, and this facility to answer a few questions for us will remain open for a short while after the webinar ends. So thank you to all our presenters and to all, and goodbye.